because we're in the point in the deal cycle where the brokers will try to sell you anything. They're just trying to cash in before too many investors get burned and the demand dries up. But, and this is a huge but, not all of these new listings are actually junk. I found one, but you gotta know, I found a good one. It's called Doximity, Doximity. I know it sounds stupid, but it's not. Listen, this is basically a social network for doctors. LinkedIn for MDs, a place where medical professionals can exchange ideas. At the same time, they have a bunch of cloud-based tools that help doctors conduct day-to-day tasks, simple with hiring, contacting patients, even telemedicine. More importantly, because Doximity is the dominant player in the category, it's become the ideal platform for advertisers that are trying to market their products to the medical community. And there's a lot of money in pitching new drugs to doctors. Now, Doximity came public nearly a month ago. Very well received, offering one of the few. Stock price at 26, open at 41, before jumping to the mid-60s at its peak a week later. Since then, it's been a bit of a wild trader, first falling to the mid-40s, good chance there. Then bouncing back to the mid-50s this week as the quiet period ended and a bunch of analysts initiated coverage. With buys, geez, the research on this is what gee, everybody loves this thing. I think Doximity does have a great story, but at these levels, it's got a little rich. That's why I recommend putting it on your shopping list and waiting for a nice pullback before you do some buying. Why do I like this one so much? Okay, when I say these guys have the dominant social network for medical professionals, I meant their network contains over 80% of all physicians in the United States. They're bigger than the American Medical Association. This is a terrific niche with very deep pockets. Lots of small business owners, okay, doctors, right, who need to buy all sorts of things for their practices. Total addressable market, let's see. In America, we spend $4 trillion on healthcare every year. 70% of that is spending. That spending is directed by doctors. And Doximity helps companies, especially drug companies, market to those people. $4 trillion, Doximity, Salesforce, you got it. Doximity has only been around for 11 years. So I think it says a lot that it's already had such widespread adoption among doctors. Normally, this is not a group that eagerly embraces new technology, at least not for back office stuff. The federal government had to spend billions of dollars over the last 20 years just to convince doctors to use electronic medical records. But apparently, they do like Doximity. And it's not just the social network aspect. Doximity's created a suite of mobile software that makes it easier for doctors to operate when they're not in the office, which is often. Lots of little things, like sending and receiving electronic faxes from your phone, or calling patients, get this is one of the favorite features, calling patients from your cell phone while displaying your office number rather than your personal number. Some patients will call their doctors endlessly if they had those cell phone numbers. I think it's a very smart business model. They build out a big social network for medical professionals, then they keep adding new tools to the platform and make life easier for their users. Plus, the social network side gives them a treasure trove of valuable data on what the industry cares about. How about the financials? This is one of the reasons, again, why I'm drawn to this. Unlike so many recent software IPOs, Doximity's got two things that I really like: high revenue growth and profitability. Two great tastes that taste great together. In the latest fiscal year, the company had 78% revenue growth, a huge acceleration from just 35% growth the year before, but a lot of that was due to the pandemic. Doximity made the brilliant call to launch a telemedicine business at the beginning of last year, which was terrific timing because COVID obviously made that offering a lot more attractive. That means the growth will likely decelerate, though, now that we've lapped the telemedicine rollout. The analysts started rolling out coverage on Doximity this week, and on average, they're looking for 34% sales growth in the current fiscal year, followed by 31% next year. Sounds pretty reasonable, although I think that number is beatable. Even more impressive, not only is Doximity profitable, it's been profitable for years. And the margins keep expanding rapidly. You know, I tell you that's what people want to see, expanding those margins. Balance sheet's excellent, cash flows are strong. How many companies that have come public with spate of deals can call themselves profitable with pristine balance sheets? I can probably count them with my fingers at best. Maybe a couple of toes in there too. Now, this is partially a cloud-based software company, so you've got some industry-specific metrics here too. The net revenue retention rate tells you whether existing customers are leaving the platform or spending more money on it. Last year, Doximity's net revenue retention rate was up 153%, meaning existing customers spent 53% more than they did the previous year. Wow! Meanwhile, the number of customers spending more than $100,000 grew from 141 to 200. In short, Doximity's got fabulous fundamentals. I think it's a very good company, but I do worry that the whole IPO class in 2021 will collapse under the weight of so many crummy listings that are coming right now. I see them. I don't like them. So what'll happen? Well, it'll get dragged down, but that's when you need to pounce. Buy. Because your earnings are so small, you can't really use them for valuation. And when you use a price to sales multiple, it's pretty nosebleed. With a $10 billion market cap, Doximity is trading at more than 35 times this year's sales, 27 times next year's sales. That's substantially more expensive than something like Viva Systems. Really good. Another cloud-based software play for the healthcare industry trades at 23 times next year's sales. However, Doximity is growing faster than Viva, so it will certainly deserve some kind of premium. I usually don't recommend stocks this expensive, but profit, great market. The valuation's not insane. It's just insane. Then there's the other problem with the stock. When Doximity came public a month ago, they did what I call a sliver deal. That means they only sold a small chunk of stock, just 13% of the shares outstanding, in the expectation that a lot of shares would produce a big spike, and that's exactly what happened. However, when the lockup on insider selling expires near the end of the year, you have to expect Doximity to get hit, right? It might end up selling off from those levels. Hey, maybe that's where you want to wait. It's okay. Patience. No hurry to pull the trigger. If you really wanted to, you got my blessing for a small position when it's trading less than 25 times next year's sales, meaning the moment it goes below 51. Remember, it just did that. Outrageous valuation. But all the cloud stocks with fast growth and actual profits have outrageous valuations. That's just the lay of the land. The bottom line, Doximity's got an exciting story. But like so many of the best recent IPOs, the stock is very expensive. And in 5 months, it could get hit with a wave of insider selling when that lockup expiration occurs. I think it's worth buying on any real weakness. But please, leave room to buy more on the way down. This one is a keeper. Stay with Cramer.